Hey traders, today we've got a very important lesson for you. What I've seen in my experience is that one of the things that traders struggle with the most is dealing with ambiguity. How often do you hear traders talk about waiting for confirmation? Or speaking about we want to be certain that the market is doing this or that. Well, the truth is that you will never have certainty. And even if you're waiting for quote unquote confirmation, it's very rare that you have full confirmation anyway in terms of what you're looking for. So here is the concept that I want to explain to you. And you need to understand this if you want any hope of making money long-term as a trader in the first place. The more certainty you are waiting for, the worse your risk to reward is going to be on average. All right, if you want a very high win rate, it's actually very simple. You just widen your stop loss like crazy. The wider your stop loss, the greater the probability that you are going to be able to eke a profit out of that trade. So whether that's a 5% return on margin, a 10% return, 100% return, depends on the size of the move you're playing for. So I'll give you an example. I could go short the market right here, for instance. Now we can see that in Euro Yen, the market actually ran quite a ways up, like around to 164.30. So if I have my stop loss wide enough, you'll notice that we never got stopped out, even though the market ran against us for over 1.5%. And when we dip back here, you can see that we would have had the opportunity to eke a profit out of this trade. Now, in this case, it would have been like a 13% return on margin, which is hardly going to set the world on fire. But I'm just doing this to illustrate a point that the more certainty you want, mathematically speaking, the worse your risk to reward ratio is going to be on average over the course of your trading career. On the other hand, how often do you see this on Instagram where you see that picture perfect entry and you see the 33-to-1 risk reward ratio? So here's the other thing, all right? The tighter your stop loss, the lower your win rate is going to be on average, but the higher your profit factor is going to be as well. Now, over the course of your career, you will find those excellent trades where the probability of being right and the risk reward is very, very high. Those are obviously the best trades to look for. Those trades don't come around all the time, despite what you might see on YouTube or Instagram or TikTok or whatever. If they did, there would be a lot more successful traders out there. And it has nothing to do with having more knowledge than somebody else or more experience than somebody else. This is simply the mathematical realities of trading an efficient financial marketplace. It is that simple. So the concept I want to talk about today is, what does good technical confirmation actually look like? Now that's going to be different from trading style to trading style and trading plan to trading plan, but I'm going to give you a couple of my hacks. All right, so we're not going to be focusing solely on Elliott Wave Analysis here. We're going to be talking about some other means of technical analysis. So in Elliott Wave terms, I just want us to focus on a couple patterns here in Euro Yen. So this one right here, I just want to focus on the red arrows here. So clearly that looks like a three-wave movement. And in fact, it was obviously a three-wave movement because it gets completely retraced. So whether we want to count this as something like, A, B, and C, or if you wanted to force a more complicated count in there, like a WXY, you're more than welcome to. The point I'm trying to make is, at what stage do you feel confident that the corrective sequence is over? Is it once we break to a new high? Well, guess what? That's where you might run into a flat pattern and you might get stopped out anyway. So it depends on whether or not we break to new highs in 5 waves. Well, here, as we break higher, we only have 3 waves. So you don't really have confirmation until you sit through this deeper pullback, which is a 4th wave, and we break to a new high, which is wave 5. At which point, the risk-reward ratio on the trade is going to be poor. Doesn't mean it's unacceptable. That's entirely up to you and your personal risk tolerance. But in based on my trading plan, the risk reward at that point would be unacceptable. So on the other hand, what do? As soon as we break to a new low, wave C, somewhere around here, do we buy the market? Do we wait for the wave B extreme to get taken out? There are all sorts of entry points you can use. And I don't think any of these entries are necessarily bad or wrong. I just want to raise the question of what does good technical confirmation look like to you, because it's going to be different for every single trader. The point is, there is no such thing as having perfect confirmation. You want to find this sweet spot where you're balancing the probability of being right, ideally by more than 50%, with a good risk to reward ratio. So this is where we talk about the coin flip game. I call heads, I win. You call tails and it lands on tails, you win. Now that's a 50-50 game. And probabilistically, if we flip that coin, 10,000 times, we should roughly end up at break even. I shouldn't end that game after 10,000 flips of the coin with significantly more or less money than you. On the other hand, if every time I flip the coin and I win $2, and every time you flip the coin and you win and you only win $1, well, I'll play that game with you all day long. Now, based on the random distribution of results, it's very possible that after 7 or 8 spins, or flips of the coin rather, you're actually ahead and I'm losing money. But over long term, over a long time frame, I will annihilate you. I'm statistically virtually guaranteed to annihilate you over a long term, over enough coin flips. So that's the point I'm trying to make here. Trading should be about having a large statistical sample size of trades in mind. So based on my own statistically exhaustive study of chart patterns and how to enter and exit, I'm going to give you a couple of hacks. So one of the things I look for, all right, I love trend lines. The reason I love trend lines is because they simplify market analysis and trading. Now, I'm not saying that you should trade trend line breaks. I'm just saying that sometimes the count on a market is very jumbled. It's very confusing. For example, here we have a very clear 3-wave sequence. In hindsight, it's very clear. But as we're counting this in real time, you could think, well, this is 1, this is 2, 1, 2, 3, 4, 5. This is wave 4, and maybe this is a truncated wave 5. We're going to get an A, B, C, and then we're going to come crashing off. There's so many ways to count this in real time. It's a little bit confusing. So what do I like? I like using trend lines. Now, there's many ways to draw a trend line, and technically, so long as you're connecting 2 points, that trend line is valid. Now, what I want to point out to you guys is in Elliott Wave Analysis, Ralph Nelson Elliott actually came up with a really cool way of drawing trend lines, which is relatively mechanical. I say relatively because there is still a degree of subjectivity in terms of how you count the waves. So one channel that Ralph Nelson Elliott came up with is the final channel, which is where you draw a trend line connecting the end of wave 2 and the end of wave 4 and bringing a parallel of that line to the end of wave 3. And if the market breaks below that final channel, it's a very strong sign. It's not a guarantee. It's a very strong sign that we have a change in trend. So I'll show you how this works, right? So in this case, we're going to focus on this particular pattern here. So remember, I said this could be wave 2. If I wanted to be super bearish, that would be my wave 2. And then this would be my wave 4. So I would draw the 2-4 channel like so. And you'll notice that we've shortly broken out of it. So that's my initial sign that there might be a change in trend. And then I have to look back and say, well, maybe this is wave 1, this is wave 2, this is wave 3. We didn't overlap the high of wave 1, so this could very well be wave 4, and I could be trading for wave 5. Now at this point, it becomes very easy to start taking risk. I'm not trading the trend line break necessarily. What I'm trading is the balance of probabilities that we've gone through the upper resistance line here of this final channel, and using the rules and guidelines of Elliott, we can now place a stop loss just below the extreme, the end of wave 1. Why? Because wave 4 cannot end within the price territory of wave 1. And now we can start looking for a risk-reward calculation to see whether or not we have a trade on our hands. Just to get back to the prior highs, assuming that this 5th wave is going to be truncated, would see us getting almost a 200% return on margin on this trade. All right, so, and I think you could easily have gotten 250%, if not reasonably more than that on this trade. So the point I'm trying to make here is that you want to use all the tools you have at your disposal, combine those with the rules of Elliott, and you will find high confidence, high probability entries. Now here's the other thing. Now let's say, okay, that we didn't like that entry for whatever reason, we didn't like that entry. We wanted to wait for quote unquote more confirmation. Well, so what does that mean? It means I'd be looking for an impulsive rise out of the break of that trend line and look for another corrective pattern to emerge. And then I can trade that corrective pattern at one lesser degree of trend. That is a favorite technique of mine as well. So you'll notice now let's move to a real market. So we have a similar thing going on here. Well, how impulsive is this? Is this a wave 1? Is this a wave 2? Is this wave 1 of wave 3? Then we have a flat for wave 2 of wave 3 and we're going to come crashing down? Well, I don't know. No one knows. We can balance probabilities, but we can't be certain of anything. What I can tell you is just based on counting this, I think there's a couple of options. You can either go A, B, and C. That's pretty straightforward. Or you can go A, B, C, W, X, A, B, C, Y. Otherwise, I think the most bearish realistic count would be some kind of leading diagonal. 1, 2, 3, 4, and 5. So either way, what we can see is that no matter how you want to slice it, there's a couple basic trend lines we can draw. We can draw a trend line connecting those 2 points here. We can draw the 2-4 trend line here, and you can see we've got a break. So what that tells me is that at least for now, the trend is pointed to the upside. So the problem is I don't have a very clear wave 1 extreme, to take advantage of. Because now I'm losing sight of the larger picture here. Is this my 1, 2, 3, 4, and 5? Possibly, which means I could potentially get away with a stop loss down here and trading a break of the line like this. And then just to get back to the prior highs would again give me a 200% return. And that's assuming I'm bullish. I'm going to show you a few ways to trade this on a bearish basis as well. The other thing I can do as well, we've gotten a break of the trend line. Right? Let's say this is the break of our trend line. What I'm waiting for is 5 waves up now. 1, 2, 3, 4, 5. And as the market pulls back, I'm going to look for a buy entry. That's trading the next lower degree of trend. All right, that's a great technique to utilize because it can get you into a trade a lot more quote unquote safely if that's what you're concerned about. And then the bearish scenario would be, well, where am I wrong? I'm wrong if it retraces 100% of wave 1. So now I can wait for example, a 61.8% pullback, place my stop above the high here, and then look for a much larger move to the downside. Now that comes down to how confident you feel whether or not this is a 5-wave decline. There are many options. There's almost always a way to tease the market and pull apart and look at it from both a bullish perspective and a bearish perspective. I'm far less concerned with whether you get the direction right at first, because you can always take the other side of a trade. It's more important to have parameters in place, which is going to, quote unquote, confirm one scenario or the other. The money-making aspect then comes down to risk-reward ratios and how good you feel about what is personally acceptable to you as a minimum potential reward relative to the risk you're taking on a trade. All right, traders, thanks for watching. See you next time.